Well, we trust you enjoyed your comfort break with Arno. What an amazing homegrown talent for all of us to be proud of. We certainly need to continue to support our local musicians. Well, we'll now be joined by Victoria Rivers from Morningstar as she discusses SA multi-asset funds. Time to go defensive. Now, she'll be unpacking this theme with several panelists: Tim Acker from Allan Gray, Pallavi Ambakar from Coronation, Leonard Kruger from Prudential, and Rob Spanjaard of Resco. Get ready to be entertained by this debate.
Good morning, ladies and gentlemen. On today's multi-asset panel, I am joined by Pallavi Ambakar from Coronation Fund Managers, Tim Acker from Allan Gray, Leonard Kruger from Prudential Investment Managers, and Rob Spanjaard from Resco. I hosted the multi-asset panel at the Investment Forum last year, and the focus was on what we termed the big disappointment: the 5-year drought of real returns and returns in excess of cash from multi-asset funds in general. And my goodness, what a difference a year makes. If we have a look at the slides, you can see that these show the rolling excess returns of both the high equity sector over cash and the low equity sector. And both the high equity sector and the low equity sector are generating returns now comfortably ahead of cash. So while advisors and investors are delighted with these returns, one of the questions we have received a lot of focus on was the drawdown experienced by particularly the low equity funds in 2020. Now, Rob, you and I shared the stage last year on the 16th of March, which was pretty much the peak or the trough of the drawdown. And I recall well that you had close to 0% exposure in equities in both Value Trend, your high equity fund, as well as stable. And that is evidenced by the meaningfully reduced drawdown in your stable fund. So excellent job there in terms of protecting capital. And we're going to look at your holdings now going forward. But Tim, my question to you is that Allan Gray, your alpha signature or your defining component as a house has often been the downside protection that particularly the stable fund has given investors during tough times. And 2020, you can see the numbers that actually the stable fund had a larger drawdown than the sector. Take us through what happened last year.
Yeah, thanks, Vicky. So I think for context, so the Allan Gray Stable Fund had a drawdown last year of 11% versus the market, which was down or had a drawdown of 22%. So it was more defensive, but obviously not as defensive as we would like, right? And as you pointed out, historically, the fund has been even more defensive. So what we've done historically is, if I had to simplify it, when we think the market is expensive, we've been extra conservative. So the difference last year, I think, was going into COVID, we didn't think the market was particularly expensive, but then obviously we had this very big external shock, which caused a big drop in the market. So there was a big sudden drop, but then also we had a very sharp recovery. So yes, we had a bigger drawdown than we would normally like, but we were also able to participate in that recovery. So if we compare where the fund is today versus just before COVID, so say, February last year, the stable fund is actually 12% higher than what it was before COVID. So we did have a nice recovery. And then going forward, we haven't changed anything in the philosophy. So we still have this approach of being extra conservative when we see more than average risk in the market.
Okay, thank you. So talking about philosophies and I guess drawdown, Leonard, if we look at the Inflation Plus fund, that fund has typically held more equity and had more property than the average low equity fund, as evidenced, I guess, by the drawdown and similarly with the recovery. But the one aspect that surprised me was the asset allocation, particularly your exposure to listed property. So I know the fund is run according to a strategic asset allocation. It's historically had about 15% in property. And I noticed that post the sell-off in property, that exposure was reduced to 4%. Have you changed the strategic asset allocation?
Yeah, so it's the strategic asset allocation that we often refer to is something that we continuously review as markets evolve and as you learn more about asset classes and how they actually develop and behave under different circumstances. 2020 was a unique set of circumstances, and I think whereas we're always guided by the strategic asset allocation when we set the asset allocation of the fund, it is not the holy grail, and it's not something that we slavishly follow. So I think in the case of property last year, the events around COVID and the implications that that had for property specifically, I mean, just this conference being virtual in its nature, you know, the fundamentals of property had changed very, very dramatically at the same time where there was concern around the balance sheets of those companies. So it's not a decision that we made in isolation. At the same time, a lot of other asset classes were also falling very dramatically. So all of a sudden, the risk reward changed very dramatically in property, but also versus other asset classes. And so what we essentially decided during that time is to, you know, yes, maybe property is oversold at the moment. That's why we didn't exit the asset class completely. But there are very attractive other opportunities, whether that be in nominal long bonds. Remember, the bond yield also sold off very, very dramatically, or just in other equities. So typically, I think it's important that you look at both sides of the coin rather than just one asset class in isolation. But you are right around the asset allocation, which is now sitting at around 5 to 6% still.
Okay, so has this SAA changed?
Officially, it hasn't changed. It is something that we discuss and debate very, very rigorously internally. And it's something that we look at. But I think the most important thing is what is our actual asset allocation? And that is where we think now is the most appropriate place to be.
It's a reflection of where you're seeing opportunity.
I think that's right.
But I'd like to talk about listed property because it's an asset class that is looking quite attractive on a valuation perspective. I know we've seen a bit of a rally in the sector. Obviously, fundamental risk exists, and there's still a lot of unknowns around, particularly in SA, the SA counters. But it is an asset class that is under-owned or represented in everybody's portfolios, and yet it used to be a darling of the market. So Pallavi, I know Coronation have historically held quite meaningful exposures to property. You're not seeing opportunities in that sector?
No, not currently. And I do agree the valuations look very attractive. I mean, we've done quite significant deep dives into the property sector, looking at the quality of the underlying property holdings, balance sheet structures in the sector to understand exactly how much value there is. But I want to just echo Leonard's point. I think you have to look at the attractive valuations across SA asset classes, whether it be SA equities, SA bonds, or SA property, balance the return available with the risks inherent in each sector. And I think for us, I think the structural headwinds that property were facing pre-COVID have almost been accelerated and amplified with COVID. And for certain sectors like the office sector, where they were just simply facing excess supply, I think now work from home is a more significant trend and a more significant headwind for property. So all in on property, I think when we balance the available returns with the risks in the sector, we're just finding better risk-adjusted returns in SA equity and SA bonds at the moment. That may change going forward depending on the relative asset class performances, but for now, I think definitely we would rather be positioned in the other two asset classes in the SA space.
Okay, bonds for yield and equity for capital growth. Rob, I'm keen to hear your views. You know, you have some strong views on property.
Property, I think a couple of asset managers, we had a similar kind of view. If you compare it to the UK standards, Australian standards, we're very sort of strong industry standards, how you're accounting for the cash. So you used to look at a property share and it is an 8% divvy yield. But actually in South Africa, they weren't really 8% divvy yields. There was a lot of messing around the cash. And so as soon as the property sector gets to a stage where there's a clear standard like you've got in the UK on this is how you account for cash, and you can believe the divvy yield, it gets much more constructive. I think the property sector needs to get there. I don't think they're there yet. And I'd echo that sentiment of there's just way too much office around.
Okay.
So I just wanted to make one last point. I think there were three main issues, and we're sort of touching on them, but just to summarize it. The one is sort of there were pre-crisis, there were a couple of tricks that some of the companies were doing to sort of enhance that apparent yield. Then 2 is the balance sheets of these companies. And then 3 is the impact of COVID. So I think to talk generally about the asset class is actually very difficult at the moment, and very asset-specific or company-specific work needs to be done to sort of tick off those 1, 2, 3 issue points. And certainly in the case of Prudential, we are actually finding individual opportunities where we see actually a path to balance sheet repair, where we see actually maybe the distribution of properties that the company has is actually not that poorly impacted. Say it's not exclusively offices, say in Sandton, for example, and 3 that the valuation probably reflects a lot of that bad news already. So it's a very bottom-up, hard work sector, I think, for asset allocators at the moment.
Can I interrupt one point on that?
Yeah.
It was like fascinating investment forum a couple of years ago. If you're sitting with a financial advisor and you get onto this argument, I know you guys might have had the same thing. What about property? And his clients that had property had given you this 8-10% divvy a year with 8% growth. Any advisor, if you said to them, guys, there's a problem here, they were like, oh, no, my clients don't touch the property. I don't know if you guys had a similar kind of thing. My end client is like, leave my property alone. And as much as you try to say, look, here's a problem. I know I heard Alan Gray talk very similar kind of things. Here is a problem. No one would listen. Yeah. So we, in our game, we've got to try like what's going to do well over the next 3-4 years. And so often everyone wants to, and we do it. I mean, we're human, but it's trying to not just look what's done well over the last 3 years, last 4 years. What's going to do well over the next 4 or 5 years, and that's what we pay to do. And I think that's important.
Well, I think if I can sum that up, it's companies may go out of business, but sectors don't. So it's a stock-picking market at the moment, but there's definitely a lot of negative sentiment around it, even from an advisor's perspective. It's gone from being the darling of the market to being almost hated, and nobody wants to touch property now. So I want to look at the asset allocation within your funds, because these are some good talking points. You've spoken about opportunities and equities, but what this slide highlights is the blue bar is the range of returns over the last 3 years that each one of these low equity funds, just to be clear, that these are the low equity funds of the represented on this slide, and the red dot is the current allocation. On the left, it's domestic equities, and on the right, in grey, it's the global equity exposure. Now, a standout here, Rob, is from a ResCo perspective, the underweight exposure, particularly to global equities, and then on the local equity side. I'm keen to know that on the global side, that there are so few opportunities to hold a 2% allocation.
There's 2 aspects that one is the rand, stable fund or non-rand exposure is now only about 12%.
Okay.
So it doesn't leave you much to play with. And then we've got the 2% direct, and there's about another 8% that we found stuff we like and then hedged it against stuff we don't like. So you can find there's some of the big indices are actually quite expensive, but if you scratch around, there is stuff you can find. But we feel the rand can, weirdly enough, strengthen quite a bit from here. So how much you can play with on your offshore limits that quite a bit.
I mean, historically, global equities have actually been a better protection against a rand than actually just having dollar cash, because you just get the full effect of the currency. But Pallavi, if I look at Coronation, you stand out as the one manager that's pretty much at the top end, both on domestic and global equities. So you're still seeing good opportunities on the global side.
Yeah, I think we were quite active last year in increasing our equity exposure, especially post-crisis. I think the valuation opportunities were almost, once in a lifetime kind of opportunities. We started with picking up global equity exposure, simply because, our thought process there was that, global economies would come out of the crisis a lot faster than SA. But as we moved throughout the year, we started seeing the SA companies reporting much better results than even our harshest expectations that we tried to put in to incorporate the uncertainty of COVID. So valuations were looking extremely attractive. Now, if you compare where we sit today versus pre-COVID, we are sitting at higher equity exposure, but I will also say that this is not capturing the percentage of equity that we have hedged with put protection. So our global equity exposure would have about 25% put protection against it. We do recognize that certain markets are very expensive, but we'd still like the fundamental opportunity to be exposed to these growth assets. So we have the assets, but we've also taken the insurance on the other side on both global equity as well as local equity. We have the put protection there.
It's interesting that the protection. So, Rob, you mentioned it. Pallavi, you mentioned it. Tim, I know that Allan Gray has got quite a large hedged exposure, both on the domestic side as well as global. And I've got two tracks here that I want to talk about. But first, on global, obviously, this rotation into value has been very favorable for Orbis, which is a lot of the global exposure you have. Why would you hedge out a large proportion of the equity in the stable fund at this point?
Yeah, so on the global side is particularly where we've used quite a high hedged equity weight. So I mean, the short answer is we think global markets are reasonably expensive, right? So there are areas of the market we think are attractive and where we like to own those companies, but global markets as a whole are reasonably expensive. So we're able to buy those shares and then hedge out the overall market to some extent.
Just to interrupt you there, but if your expression is through Orbis, and I know Orbis is materially underweight the US and different sectors, would it not be a clearer expression to have a net exposure to Orbis rather than a hedged exposure?
So we do have that, but we also have the hedged equity. So it's a combination. And then just to touch on the value point you made. So as you know, Allan Gray and Orbis, we're not pure value managers, but we definitely have this value bias, and we do own more value stocks. And part of that also comes into this hedged equity discussion, in that if value markets start doing, or value stocks start doing better, that could turn from being a headwind to being a bit of a tailwind for the global stocks we own, although, that doesn't have to happen, but it could be a nice tailwind. And certainly within this hedged equity component, the parts of the market where we own are definitely more on the value side of the market on the global side. So that could be a nice tailwind going forward.
So what's the downside to investors of having hedged equity? What needs to happen for that thesis to work out? Tim, on your side.
Well, so the downside is you have less gross equity exposure, right? So if markets do really, really well, like the last 10 years have obviously been a phenomenal bull market globally, especially in US equities. But really the last year since COVID has been obviously like a massively strong recovery. So if markets keep flying, you don't want hedged equity. You just want to own the equities outright because they're going to keep going up. Okay. And we're quite concerned about valuation. So we think the likelihood of that is probably decreasing.
Okay. So within SA, a lot of the focus has been on SA Inc., seeing good, attractive valuations there. Now, Rob, I know you spend a lot of time focusing on macros, and within your equity component, it is relatively low, but you have got some healthy SA Inc. exposure. How does that tie up with the macros story that you're seeing?
So the issue in South Africa is absolutely fascinating. Because of our PGM exports, rhodium and palladium particularly, we're running a trade surplus that probably ends up being about, it could be as high as 10% of GDP. And that's massive. That's like Middle Eastern, it's a massive problem. So you've got this economy that was in recession pre-COVID, which otherwise would probably still be in recession, but you've got this ridiculous amount of money flowing into the country. So if you look at it, and it's good for our banks. It's good for our platinum miners. It's good for our banks. And you can question whether some of the SA Inc. does well on that. But if you look at a standard bank 2-year note, trades at the same yield as a 2-year RSA. So you've got this weird situation, and it's not. If we just had a flat trade balance, I think I wouldn't be touching SA Inc. shares, but because of this weird situation you're in, anything can happen. So the rand could go to 11, 10. Or there could be a taper tantrum and the rand could go to 16. And that's where I think multi-asset funds are well placed, is you've got to be able to pull these levers. And I think the multi-asset guys can do that rather than just like one strategy, which is income.
Yeah, I want to touch on that point. If you reference back to the slide that you had up a little earlier, you would see the Prudential Inflation Plus Fund. What we've essentially done is looking at those ranges that we've had over the last 3-4 years, is we're now as low in global equities as we've been in that time period, and in SA equity we're actually as high as we've been in that period. And it sort of echoes the points that Pallavi and Rob is making, in that, you know, global equities are on the more expensive side, just if you look at the macro market sort of metrics overall. But then in South Africa, you've got this very, very extreme scenario where the largest call at the moment in our minds is what actually happens to these commodity names. Because what you're essentially seeing is a phenomenal trade surplus, phenomenal levels of profitability in the mining sector, and hopefully that filters through into some of the adjacent sectors or communities. But then you've still got this narrative around extreme pessimism around South Africa's longer term outlook, and hence the valuations are not that stretched, in our opinion, at all. So for us, you know, when we think around asset allocation at the moment, you know, really South Africa is actually where the opportunity lies. In the equity space specifically.
Yeah, and Vicky, sorry, just to also emphasize why we think SA equities can potentially do quite well in the next 2 to 3 years, is I think people are underestimating the dividend return potential and the cash return potential from our SA equities. I mean, if you look at the different sectors, I mean, the resources sector, as Leonard said, has done extremely well on the back of high commodity prices, but many of these counters are actually sitting in double-digit dividend yields on a one-year perspective. I mean, we're talking from anything ranging from 12 to 20%. You look at our banks; they couldn't pay dividends last year, but they've been allowed to resume dividends. They come out of this crisis in very healthy capital positions. They're going to start returning capital to shareholders, and some of these SA Inc. shares as well. You know, they have focused on some growth opportunities, but by and large in very healthy balance sheet states, and the potential to return cash, I think, is highly underestimated by market participants. So that's quite attractive for us in the low equity, low risk space, because it does take some of that, you know, downside risk away from the SA equity perspective.
Okay, thank you. Talk about low equity, low risk. I want to focus on, and I'm going to highlight a slide here where there's a commonality across all managers. So this is the cash holding within the low equity funds. And again, the green bar highlights the range that the funds have held over the last 3 years. And pretty much everybody is at their lowest ranking, so lowest holding. So we know that cash rates evaporated last year, and it's made it very challenging, particularly for multi-asset funds on the low equity side, who need 60% in fixed income. And then if we look at the other side of the fixed income spectrum, we've got long-dated government bonds, very steep yield curve, yielding 9% odd, 6% real return. You've got a healthy yield that does offer downside protection, but it does come with duration risk. So where does the risk sit now within multi-asset funds? Is it on the equity side or is it on the income side?
There's risk everywhere. Yeah. And it's not that, but here's the problem. So as Tim says, we also look and you see equities and it's like, wow, look at the divvy yield, look at the growth there, and we're all loving it. But in a lot of cases, those are cyclical shares. Yeah. And when the music stops, when something goes wrong, you're going to get killed there. So it's just, there's a lot of stuff that's tempting you. Now, the counterpoint, the income funds, and we would argue that stable funds are much better placed than income funds. Why? Because 2 years ago, an income fund could get 9.5% with no duration risk, nothing. They could just buy a First Rand Bank 1 year floater, and they could be getting above 9. So that's no duration risk, 9.5%. The problem is the yield curve's done that. So as you said, you're kind of ending, and the spread on the floaters has fallen. So this was so for a First Rand 2 year note gives the same as a South African government note. So you're not getting that spread anymore. So with no risk, you end up getting your 4.5%. And that's why even income funds, you're forced to take some risk. So to get 9%, you've got to go right. You've got to own 100% 2030s. 10 years, and so if something goes wrong, there's a taper tantrum, they're not going to have that smooth return. There's risk of big drawdown. So that's why multi-asset funds, you need to be able to pull these levers, and we think there are more levers to pull. Multi-asset funds have got more levers to pull, where the income funds can literally pull duration or not duration. And they've got to work for their money now, where they didn't have to work for their money. It was easy. It was just income fund manager. You just stick it all in floaters and get your 9%. And that's going to be fun. Sorry.
Yeah, sorry, Rob, but I think as well what people don't understand or realize is the amount of risk that's increased at the long end of the curve, and in terms of not just duration risk, but credit risk or counterparty risk, because you're getting those extreme yields or those very healthy real yields by lending to the government. And government's fiscal position and their debt to GDP ratios are looking far worse now post-COVID than they were 2 years ago. So maybe you would be happy to take that duration risk pre-COVID. Their balance sheets were looking okay. But I think post-COVID, you've got a very different stance. And yes, the outlook is maybe in the shorter term looking a lot brighter because we've had the trade surplus and commodity prices that will help. But nevertheless, you're sitting with a government debt to GDP ratio of 80% plus in 3 to 4 years' time. So that's quite significant credit risk that you're taking as well.
So Rob mentioned that Standard Bank paper and first round paper is trading at the same spread as Gavi paper, but surely the state of the state of the banks relies on the state of the fiscus. So it makes no sense for credit to be trading at those yields or those spreads. And if I looked at your portfolios, high and low equity, Prudential, Resco, meaningful exposure to government bonds, grey, average, and then Coronation, you're pretty much at your lowest point. I'm keen to hear, Leonard, from you, the opportunity you're seeing. Pallavi says there's risk that exists.
Yeah.
What's your view?
Yeah, look, I don't disagree with the risk, and it's something that we're very cognizant and aware of. I think what that slide of yours sort of alluded to is that multi-asset allocators need to work a lot harder now to think around getting a solution. You can't just park in the simple cash solution. So we've done a couple of things in our funds, for example. Yes, there's the risk return argument around going out on the duration side, but we've tried to look at a couple of other cash proxies, maybe just a little bit beyond the traditional money market space, which doesn't come with that sort of large credit, longer term concerns. And then also, I think a sort of a secular trend that we've been very aware of is just globally, real rates have collapsed. It started in Japan 30 years ago, it went to Europe, it's gone to America, and now it's sort of effectively moved into a lot of emerging markets, and South Africa is one of them. So I think when we look at our cash position, we don't just look at SA cash, we actually look at offshore cash now as well. And actually, if you had to do a slide on that, we would actually look a bit higher in offshore cash. Yes, you're not being paid there, but you're not being paid in South Africa as well. So what you're essentially getting is some of that cash now brings in this offshore cash. It brings you a little bit of that offshore diversification and protection against the rand.
Would it not bring in currency risk? So while we're getting less in SA cash, we're still getting 4.
That's right. Yeah, so you do get a little bit of currency risk, but that is also then part of your consideration around your total offshore exposure, where offshore equities are looking a bit more expensive. So you don't have to just think offshore equity or nothing. The trade-off isn't as simple anymore, because the alternative in SA cash just isn't as attractive as it was last year, this bit more than a year ago.
So I think what Leonard is trying to say is that as multi-asset fund managers, what we're trying to assess is not just the return potential of the whole portfolio, but also how the risks interplay at the whole portfolio level. So yes, there are risks and returns in each individual asset class, but how you bring it together is what the portfolio manager does. So for ourselves, yes, we see the very attractive yields in SA fixed income, but however, we wouldn't be long duration, or we wouldn't be at duration. We're actually under duration versus the Orbi index, because we've chosen to take the risk budget in our fund with a higher equity exposure. So all the time we're balancing the risks and return potential of each asset class.
The alchemists, that's what you guys are. So one of the points you highlighted, Leonard, which is a good one, is the impact of is negative real rates. And this is one of the first times we've seen negative real rates in SA as a function of rates being cut as opposed to inflation, rates playing catch up. Tim, what is an environment of negative real rates? What benefits in that environment, and what is the most impacted? Obviously, cash rates is obvious in terms of impact, but who gets the tailwind from that?
Yeah, so on the cash side, as you can see, everyone's very low in cash, so cash rates are rubbish, and there's no, like we've historically had a very high cash position in our stable fund and owned hardly any bonds. So I think a lot of that money is flown into bonds. Like that's been the practical implication, is that people have gone out on the yield curve and tried to get more yield, and we've done a similar thing to some extent. So, it makes much more sense to buy long bonds at 9% than cash, at 4%. It's much more attractive. But we are quite cautious about bonds. So we do have a bit lower position in bonds than many of our peers. I did mention historically we've had very low position in bonds. We've increased that. We do think it's attractive. But it is quite tempting and possibly dangerous to say, you can buy a long bond at 9, 10, 11% and it's risk-free, where we all know it's not risk-free, right? And I think we view risk kind of in two ways. So there's risk as volatility, and a bond is less volatile and you just get your coupon and it's smooth sailing. But then there's also risk as risk of capital loss. And with buying or lending money to the SA government, it's smooth sailing until it's not. And that's what you want to protect against, especially in a fund like this. We're talking about low equity funds where you have conservative investors, and you want to protect against that risk, which maybe it's a tail risk, but it's something you want to plan for. And that's why, if you think like what could go wrong, like really SA going off the fiscal cliff or a very high inflation scenario, you definitely don't want to own bonds, which are a safe investment in that scenario. You'd much rather own shares. So that's something we definitely think about in the asset allocation decision.
It's interesting you mention risk, because while people were disappointed or shocked at the low equity funds drawdown last year, I think what shocked investors more was the 4 to 6% capital loss they experienced in their income funds through any form of bond duration, even though most of those income funds were sitting at short duration. But I wanted to ask a question around putting it all together at a portfolio level. So historically, bonds have been quite uncorrelated to the currency. So when we've seen the currency sell off, we've seen bonds sell off, but you had currency protection because you've had the weaker rand. And then when we've seen the currency strengthen, you've seen bond yields fall as lower inflation expectations come through. So they've worked quite neatly. But last year we saw those two correlations almost go to one. Do you think that's a phenomenon that's here to stay, the increased correlation between bonds and domestic equities, or a one-off COVID event?
Yeah, I think that's very hard to predict, because you never know what causes the next crisis, right? History rhymes, but it's never the same. And I think you allude to the correlation, but the correlations across all asset classes actually were highly positively correlated last year. So it's not just South African bonds and the currency, it's a multitude. And I think that was one of the main sort of disappointments when we look back at the drawdowns that our clients experienced in these various funds. And that, as much as you try and put together, for these different risks, in that short 4 to 6 week panic that we had last year on financial markets, the correlations just all went to one. I
think that's a soundbite. In a smash up, correlations go to one.
Yeah.
There's nowhere to hide. But that's what guys have got to realize with income funds, that it isn't like it's just safe, that line's always going to be smooth. You correlations, you've got drawdown risk, particularly now since they've been forced to go out on the yield curve.
Yeah.
There's risk in income funds.
Yeah, maybe I'll add to that, because Rob's been giving his 2 cents on income funds, and I must say I agree. I think people underestimate the risk. So, they have their place for some investors, but people do see it as a low risk thing. So I talked about, this tail risk and risk of losing capital. So there's definitely some of that. It's smooth sailing until it's not. But then there's also, you talked about the drawdowns in income funds. So something we worry about is the liquidity for a lot of these instruments you see in income funds. So, your volatility is zero if your instrument doesn't trade. If there's no liquidity and, in a stress time that no one trades the instrument, then it looks like you had no drawdown, which is obviously, a false sense of security. So there's a little bit of that happening as well, which I think people are maybe underestimating the risk below the surface.
Yeah, I think Abel is a good reminder of how things price to zero quite quickly. So talking about income funds, I want to draw your attention to this slide. And what this slide shows you is the net industry flows excluding money market into multi-asset funds in the blue. The yellow is into multi-asset income funds or fixed income funds, and the red is global, and the other sectors are displayed at the bottom. Now, a couple of points stand out here for me. The first is that from 2012 up until 2015, multi-asset funds, they took the lion's share of flows, between 50 to 90 billion in net new flows every year. But then from 2016 onwards, that trend reversed, and you saw income funds, as Rob stated very well, it was almost a no-brainer. You got a 2% real yield with zero duration, and that almost provided a headwind for equity markets as well. But money just poured into income funds, and then it started 2019 and 2020 to move out of multi-asset funds. So actually, a lot of the good returns that multi-asset funds experienced over this last year were not experienced by investors, and a lot of those investors sitting in those income funds are going to be, I think, quite disappointed when they receive their statement at the end of this month and see the returns that they may have missed, or that they have missed out on. So, Rob, why do you think people lost faith in balanced funds?
I think there was some disappointment on the returns, but and investors, I think, are being too short-term orientated. And what happened from 2012 to 2016, you had a weakening rand environment. So most balanced funds would have their 25 and 30, and those rules have changed a bit over that time, but 25% offshore, so with the rand strengthening from the end of 2016, that became quite a big headwind. But in 2017, we had the ANC elective conference. Cyril Ramaphosa won by 75 votes. Had it been the other way, we would have got the Zuma camp. We would have had a proxy for Ace Magashule as president. With what we've seen in Zondo Commission, you would have wished you had your 30% rand. So the scenario, the changing. So it's been a reasonably tough period for multi-asset funds, and I think it's at the start of a new phase for, we've had the SA shares have been struggling. There's places you could make your returns, but I think that phase is carrying on now. On the top of the point I was alluding to earlier, the income funds had it super easy. You could get your 9% for doing squat, nothing. You didn't need any duration, and I think investors appreciated it. So sharp investors now are looking at it and think, no, but now I only can get 4%. How, as an advisor, can I explain to my client, you should give me your money, and I'm going to get you 4.5%, where they could just go to the bank and put the money in the bank. And I think that's why you start having multi-asset funds now starting to take money again, because that just doesn't add up. You can't ask a client to give you the money and get him 4.5%, but then you need to tell him about the risk you want to take if you're an income fund. On our funds, we prepare to run our high equity fund as a stable fund at times. So we'll be fairly flexible on the asset allocation. So our value trend fund, we're running pretty similar asset allocation to a stable fund at the moment, because we think that's the best risk return. But I think particularly stable funds will do better over this period, because we sat here a year ago. What's happened since then, I've never seen anything like it in my life. It was the shortest recession, the quickest recovery, and I think it's probably the shortest super bull market we've had. And that's why the flexibility you need to pull those levers, I think the multi-asset guys can do it. And that's why you'll have a flow back into multi-assets.
So if you look at the flows, what you can also see is that a lot of living annuity money has gone into income or to global. And it is interesting to see now some of the platforms put limits on global exposure, because we're seeing some living annuities that have 100% offshore. So obviously they will have struggled in this recent times of rand. Yeah. But what would you say, Leonard, to is a balanced fund still an appropriate vehicle for living annuity investors?
Look, I mean, it's always difficult and dangerous to make a generalized comment, because you never know. Every person's circumstances are unique. As a core building block in a typical living annuity, I think it is a wonderful solution. One, because it allows the flexibility to the chosen asset manager to move to where they see the opportunities are. It is not a singular strategy where something external has changed, real rates have evaporated, and all of a sudden the value proposition is fundamentally different. Yeah. In a multi-asset space, you need to have as many bullets in your in your drawer to be able to pull and to make that appropriate risk reward sort of investment decision. So individual circumstances, they are unique to each individual, but as a core, having a multi-asset, whether that be a low, medium or high equity, depending on your circumstance, I think it's a wonderful solution.
It is pleasing to see, if we look at the range of returns, how active you have all been in terms of moving, in terms of asset allocating and not sort of staying constant. But Tim, I know it's, again, a general question, so sorry to put you on the spot here, but we're asked all the time by advisors who have clients sitting in income funds, should I be moving up the risk curve into a low equity fund or into a high equity fund for my clients? Because particularly on the living annuity side, or even not on the living annuity side, or have I missed out on the returns from equities, and should I just be cautious and wait?
Yeah, I'm sorry, it's a bit of a cliche answer, but I think you should choose something and stick with it.
Yeah.
So, because important to remember is, if you, let's say, for example, you're in a low equity fund, within the fund, the portfolio manager is also changing the asset allocation, right? So at the moment, we've got a fairly high weight in the context of our low equity fund, because we think there are lots of opportunities. So in SA, we're finding lots of cheap shares, so we've been increasing our equity weight. So we're already doing that on behalf of the client. So a client could then, on top of that, decide, no, I want to switch out of the low equity one into the high equity one, or I want to go 100% offshore. But then you're making, obviously, an asset allocation decision, which you have to be quite confident in. And you also have to be confident you're going to get it right consistently. So last year, you talked about living annuities and people going into offshore funds. So last year, obviously, a lot of South Africans decided, SA is toast and I want to take my money offshore, especially in the first half of the year when we had all this COVID volatility. But actually, SA shares have massively outperformed in dollar terms, So there is this danger of just following what's done well in the most recent period, rather than just choosing kind of a strategy, sticking with it and rebalancing based on kind of if things are a little bit cheaper or a little bit more expensive.
Yeah, and I mean, just to emphasize, I mean, what you've seen over the last 4 or 5 years is clients have de-risked. I mean, that's exactly what your chart is showing. And I think what everyone is saying, I think, is there's a unique opportunity here for clients to take considered risk exposure. We're certainly seeing it from our perspective, even in the low risk, low equity space. So I think you do have the flexibility to take up a little bit more risk exposure, and clients should also be thinking about that in the context of their portfolios and how they're positioned.
Well, I think what's been made very clear today is that when you think of risk, it's not necessarily equity risk. It's understanding the risk within a portfolio. So the diversification benefits from a multi-asset fund and the ability to move different levers is actually the greatest risk reducer. So looking at total portfolio risk. But Tim, you raise a very good point about the behavioral side of investing, and we are our own worst enemy in terms of that call to action when something happens, and investing based on the rear view. It makes you feel good investing in something that's done very well, but it's not necessarily a good investment strategy. So I want to, in the last few minutes of this panel, just ask you all, potentially a slightly cheesy question, but the most exciting idea in your portfolio. If you look at it now, looking forward, like the opportunity that you think is going to be the biggest driver of returns. I'll start with you, Pallavi.
Yeah, I mean, I'm not going to give you a single name. I'm just going to give you an asset class. I think SA equities, and within that, we've got our selected stocks. I mean, you can look at our top 10 holdings to see what those ideas would be. They'd consider some, rand hedges like the Naspers process, a share like British American Tobacco, which has done nothing over the last year. It gives you an 8% dividend yield, selected resources shares, and then some specific SA companies which have used the COVID crisis to strengthen their businesses and come out of this in a much healthier state. And that can grow even if our economy doesn't shoot the lights out. So I would say a basket of select SA equities.
Okay, I'm very pleased to hear that, because for a long time, Coronation have had almost a negative view on SA equity, so it's good to see that has actually changed. Tim, from an Alan Gray's perspective?
Yeah, unfortunately, it's quite a similar answer. We're quite optimistic about SA shares. I talked about how we think global markets are reasonably expensive. We like SA bonds, but there are definitely risks. Cash is not great, so it really leaves SA shares. And that's, on a bottom-up basis where we're finding nice opportunities. We like some of the domestic companies. We like some of the banks. We like some of the hospitals, for example. Those are like really, square, like solidly SA industrial type companies. that'll obviously have SA risk, but that's also where you're getting the most attractive valuations. And on the risk reward, we think there's quite a bit of upside there.
Okay. Leonard?
As you go down the line, my options get reduced. I think within South African equities, you could find the best opportunities. I don't disagree with what the previous two answers were. I think if you're fairly astute in the commodity space, there are some phenomenal opportunities. The difficulty in assessing them at the moment is how long this sort of the stimulus effect on commodity prices persist. Because I think what we're seeing is, and we spoke about it earlier, some of these companies are on 20%, north of 20% sort of free cash flow yields, and the potential for dividends are enormous. How those companies, and when you can find a resource company that you're willing to back the management team to utilize this windfall productively, I think there's a lot of money to be made in some of those names.
Okay, so we've got commonality here, and I'm going to pose a devil's advocate question after Rob. But Rob, I'm glad I actually picked that order, because now you've got the lowest SA equity exposure of the managers.
We're excited about being careful at the moment, because there's so many things that it's almost like you're a fish swimming along and there's a lovely bit of bait that hasn't got a hook in it. So this concept of cyclicality, I think risk control is more important than anything at the moment. We do prefer SA equities over global. Clearly, you can see from the allocation. Locally, we've got banks and PGM producers. I think both are, some degree, the same trade. But I'll explain. If I had another 10 minutes, I could explain it. But banks and SA banks and PGM producers.
Okay.
But in the context of, we're not saying we're cautious, be careful. The risks are very high in the current market because of the global picture.
All right, so to play devil's advocate, if SA equities are the common theme, what's the hole in that thesis? If everybody's owning SA equities, when the contrarian trade is then gone, what else is there?
Yeah, I mean, I would answer that and say I don't think everyone is owning SA equities. Definitely foreigners aren't. So we've seen foreigners pull out of our markets. So SA is very underweight compared to most emerging market managers or global managers. So it might feel consensus between these four people, but it's definitely not a consensus global trade. And on the risks, I think we all know what the risks are. It's clear they're risks with SA shares.
Okay. Well, it's consensus amongst four very good investment managers. So it is, I guess, we've got a commonality here in terms of that. We are out of time, so just to wrap up, if I can take some of the key takeouts from today is, number one, SA obviously looking attractive, an opportunity that we haven't seen for many years as South African investors, and as a function of potentially not necessarily an improved fiscus, but negative real rates and the material drop we've seen in cash, and on a relative basis, cash looking much more unattractive. So that was also a key takeout. Property, the risks still exist, hotly debated, and government bonds, I think, is the area where the yields, particularly for anybody sitting in income funds, the yields must be balanced with the risk that is associated with government bonds. Not only the risk of the government, but the duration risk that comes with that. So beware if you're sitting in an income fund, but if you're in a multi-asset fund, it's just another good lever you can pull. And then the last takeout is, this is the first time in pretty much, I think, almost a decade that we've seen the views on offshore being at these levels, and SA being more attractive than global. So Pallavi and gentlemen, I would like to thank you very much for your time today. And as Morningstar likes to remind us on a daily and on a weekly basis, managing money is an incredibly serious job, because you are managing the savings of the nation, and how people retire depends on how well you do your job. So from a Morningstar perspective, I guess keep up the great work that you have been doing, and let's continue to serve our end investors well. Thank you.
Thanks.
Thanks a lot.